This week on the Property Podcast, lockdown begins. We all go on a mortgage holiday. Boris promises a new mortgage product. Surveyors downvalue properties by 20%, but the experts tell us the market's on the up. All those stories and much more covered in today's episode.
Welcome to the Property Podcast, where every Thursday morning property investors come to be informed and inspired. And so much to pack in, even if we were just talking about this week alone. There's big news over in America. England has been locked down again, and that's before you even get into the really big property stories that were taking place throughout the last month. So we'd better get on with it. Before we get into our market update this week, I need to let you know about something very exciting that is starting next week. We've put together with our team a completely free webinar containing everything you need to know about getting started investing in property. Now, all this information, of course, we've already shared on the podcast, in our free courses, on YouTube, but there's a real value to bringing it all together in one place, giving you a bit of a framework and giving you the opportunity to ask questions as well. So if you are new to property, you're trying to figure out how to get started, or you've been doing it for a while but feel like you're lacking direction or lacking a bit of a strategy maybe, this is the webinar for you. It covers everything from goal setting to strategy to the all-important business of raising cash. So really, really valuable stuff. Now, in property and many other industries as well, unfortunately, webinars have a bit of a reputation for you'll turn up, someone will give you a little bit of information, and then they'll give you a really big, long pitch for some very expensive product with a price that probably ends in a 7. Well, that's not the case with this one. There is nothing to buy, there is no sales pitch, and you'll be sent away with lots of free resources as well. So these are going to be running 3 times a week, various different times, so you can find a time that suits you. The first dates are now available to book, so all you've got to do to get yourself on one of those is go to propertyhub.net/action. That's propertyhub.net/action.
It's an obvious start to the market update this week because we have a new lockdown. Lockdown starts today on Thursday, November 5th, so we all have that to look forward to. But Rob, I think it's worth saying before we get into all the property stuff that there is a different lockdown to last time. It's almost what you could call a lockdown light. Now, people might not like the sound of that and think I'm belittling the situation, but it is not the same version of what we've had before. And I think we have to acknowledge that.
Absolutely. So the big and obvious one for many people is that schools are remaining open, which they didn't last time. And also the guidance around working is completely different from how it was the first time around, because it's work from home if you can, rather than don't go to work. And transport will keep operating as well to support all of that. So I don't want to get into the rights and wrongs of what we should be doing and whether this is the right thing to do or whatever, because that's beyond our remit. But the fact is that that is what's happening. So it's kind of got the same name as last time, but it's actually a completely different beast, which does directly affect property, Rob, of course, because it means that broadly speaking, the property industry can keep on going.
It does. It means people can still rent properties, people can still buy properties because they can do viewings. Of course, the virtual viewings will be there as well. But you can go and see properties, which is key to keeping the market going. And because people can continue to work, there should be no reason why surveyors won't continue to go out. Mortgages still progress. But all of that is going really slow anyway, so I don't think it can physically go any slower than it currently is. But it shouldn't affect things any further. We will see, of course, this is day one. And by next month, we'll know exactly what the impact has been. But I think while it's a shock to the system for all of us and we all have to adapt and deal with it for the next, hopefully, just 4 weeks, as far as the property industry carrying on and as property investors are able to act and transact, well, we can, and that has to be seen as good news. And the next news story that we have, Rob, could be seen by some as good news as well, is that mortgage holidays have been extended.
Yes, so mortgage holidays, which were introduced at the start of the last lockdown, were due to end at the end of October. But mortgage holidays have now been extended to the end of this lockdown, which currently is meant to be on the 2nd of December. So if you haven't taken a mortgage holiday before, then you can. I don't know how long you can negotiate one for. I believe it might be about 6 months. So you can speak to your broker or lender about that. And if you have already taken a mortgage holiday and you still need further support, then you can still speak to your lender because they've been told by their governing body to keep on offering support to people who are struggling. So it's not the case that we're suddenly going to see a load of repossessions for people whose mortgage holidays were due to be ending and are falling into arrears. Just like we said when mortgage holidays were first being introduced the first time round, not something to be taken lightly. It's not there for you to take just in case. It might create problems with future lending by making your business seem less resilient than it really is if you take it just to help out your cash flow when you don't particularly need to. But by this point, it's possible that you might be struggling and you might need that support. So if you do, it's there.
Yes, the mortgage market is really challenging right now, and you don't want to give lenders an excuse not to lend to you. And many lenders are asking if you've taken a mortgage holiday. Now, whether you think that's right or wrong doesn't really matter too much. The fact is they are. And as Rob's quite rightly said, if you don't need it, don't take it. Something else that's been extended because of lockdown is the eviction ban. Now, technically, it ended weeks ago. But Tier 2 and Tier 3 areas, which is kind of old hat now, but those areas continued to be protected. So if you had a tenant in arrears in a Tier 2 or a Tier 3 area, you were unable to have them evicted. And now with the same version of lockdown across England, this is expected to now carry on till at least December 2nd.
Yeah, we don't actually know at the point of recording whether the courts will keep on hearing cases. The courts stopped hearing cases for months. Then they eventually started again. Whether they'll stop again, I don't know. But like Rob's already said, in Tier 2 and 3 areas, bailiffs are instructed not to enter properties. So now presumably they'll be instructed not to enter properties anywhere in England, which means even if you can get a court order, you can't get it enforced. That lasts until the 2nd of December at least. Then from the 11th of December until the 11th of January, the government's already said that there'll be a break in enforcement action for that month over Christmas. So maybe there's a few days in the middle there, but basically that's it until 2021 now. So if you are unlucky enough to have a tenant who's in arrears and they're not being cooperative, then that is a really tough situation. And if you are struggling as a result, then that is the kind of situation that mortgage holidays are designed for.
Now, it's been a bit of a crazy month, as we all know. Every month seems a bit crazy right now. And normally this news story would probably make the top of the show, but as the world's a bit mad, it hasn't. But it's a big story nevertheless, and that's that Boris has announced that he's backing 95% mortgages. Now, we are a little limited on information still. I know, shocking government announcement, limited information. But Boris Johnson's promise to turn generation rent into generation buy, I think, is something that we really have to pay attention to. Because if they follow through on this, they're really going to go out their way to try and make as many homeowners as possible, which feels a bit of a change in direction from where they were going over previous years. But I suppose the logic is that they feel that people are more likely to vote Tory if they are homeowners. I know it sounds a bit daft, but history shows us that is true. So the government is incentivised to make as many of us as possible homeowners. But what happens when more and more people come into the market? With limited supply, prices go up. So, Rob, this is definitely one we need to watch.
Yeah, we're going to come to talking about house prices and price predictions going into next year a little bit later on. This is going to be a big factor when people are thinking about what's going to happen to prices next year, because the lack of high loan-to-value mortgages is a factor that can keep the brakes on property prices. If lenders aren't willing to lend above 90%, or perhaps even lower than that, then that means lots of potential first-time buyers are going to be shut out of the market. If the government steps in and encourages/forces them to do that, then that changes things completely. There hasn't been any more detail on this since the concept was announced in early October. And to be fair, all right, there are a few other things going on at the moment, so we'll have to wait for those. But it seems like it's likely to be a bit of a rebadge of the Help to Buy mortgage guarantee scheme that we had a few years ago. So the government, or more accurately the taxpayer, will underwrite a portion of the loan, so it's at no additional risk to the banks. Like you said, Rob, this is a big change of course. I could give you a load of opinion about whether this is the right thing to do or not, but that's not going to help anyone. What does matter is that if this happens, which it seems like it will be a big factor on how the housing market performs in general going into next year.
It certainly will, and it will be impacting our thinking around predictions, which we do at the very beginning of each year crazily. I don't know why we continue to do it, because the world is so crazy. But this and many other things will be certainly influencing our predictions on what we think will happen in the years to come. So you don't have to wait too long before you find out what we think will happen.
Another factor when we're looking at what's going to happen next year is going to be trying to anticipate what's going to happen when the current stamp duty holiday ends, which is due to happen at the end of March. Logically, you could say that there are going to be fewer transactions after that because there's an incentive for people to make their move before that to take advantage of paying less or no stamp duty. And Rob, people have certainly been doing that, and it's causing one or two problems.
Yes, there's been a surge in people trying to take advantage of the stamp duty holiday, which is fantastic. That's what it was put there for. But now it's created a huge backlog. And that, combined with mortgage companies acting slower than normal, surveyors acting slower than normal, means there's this huge backlog now of reportedly 200,000 people who potentially may miss out on the stamp duty holiday. Fact is, as we record this today, unless you're going to buy cash now, you're going to find it very hard to complete before the stamp duty deadline if you agree to buy a property even this week. It's not to say it's impossible, but if you're using a mortgage, it is going to be difficult, and you need to be right on the money. You need to be all over your mortgage broker. You need to be returning your funds the day you get them to have a chance. And I suppose, Rob, if you logically think about it, that story isn't that surprising. Everything's moving slow, more demand creates backlog. And related to this, but also not surprising, is there are now calls to extend stamp duty further. I've said previously that I wouldn't be shocked if this happens or an extension to Help to Buy happens next year. At the moment, it's just people asking for it, but those requests have already started to go into the government.
Yeah, not saying they will extend, but it would seem like a relatively easy win for them. It looks generous, and it's possible that the government won't actually be losing out in cash terms because they're collecting less on each transaction, but there are more transactions going on. The argument that I've seen put forward for extending it is that if there are people who don't manage to complete in time, then it could end up with chains falling apart because people hadn't budgeted for the stamp duty and therefore they can't continue to proceed. I don't really see the logic of that one because that seems like something that's going to happen wherever you put the deadline. There'll always be people who just miss out on it for one reason or another. But more relevant seems to be the timing in relation to the economy in general. So going into next year, we're going to have leaving the EU, I think. I've completely lost track of what's going on with that, to be honest, but I believe that's happening at the end of this year-ish. And it seems likely that coronavirus will still be with us in some kind of form, having some kind of effect. So if there are easy wins around to keep the economy moving and keep people optimistic, then it seems worth taking them. And stamp duty does appear to be one of them.
The next news story for me, though, is probably the most worrying. Yes, more worrying than a lockdown. Well, worrying for the property market, at least anyway. And that's an article from The Times questioning, will the market collapse with increased down valuations happening? And to summarise the article, it turns out that surveyors are being instructed by lenders to be very conservative with their valuations and downvalue them. And The Times is reporting that down valuations are happening to up to 20% off what the vendors have been asking for and what they perceive the real market value to be. Here's the thing. If they are worried about a market crash, then they are going about this the wrong way. If you tell your surveyors to downvalue your properties, well, guess what happened? They will go down in value because if everyone's forced to downvalue their properties because of lending criteria, then you're going to cause that crash you fear. I don't know who is running these companies, but it seems that they've left their brains in furlough. It's absolutely crazy that that's even happening and taking place. But I've witnessed it firsthand. It's absolutely bonkers. Rob, hopefully it's just a bit of fear taking hold and it doesn't last much longer. But this is something that isn't being really reported on at the moment, but does need attention because if it continues, it could be the trigger for a house price correction or, as the Times reported, even a crash. I'm not saying it will happen, but you can understand how it could happen.
It just flat out doesn't make sense, does it? You go and you look at comparables, you look at transactions that have happened recently, you look at the prices of those, and you use that to set the price of the house that you're valuing. And then you take 10% off it just because it just doesn't make any sense. And I have had people complain about this to me anecdotally. So it's not something that the paper has just cooked up out of nowhere. If lenders want to be cautious at the moment, that's fine. But the way to deal with that should be to reduce the loan to value, not to tell surveyors to change their opinion of the value. Now, that would still have a cooling effect on the market, and that's something that lenders are, of course, perfectly at liberty to do. But that would be less damaging to the market and create a lot less uncertainty psychologically than just randomly going and reducing values. It seems thoroughly bizarre.
Which, of course, makes the business of predictions that much more difficult. And it turns out, Rob, that Savills have found that process very difficult because they made some predictions earlier in this year. They made some predictions at the start of the year, like we did. They revised their predictions during the year, as we also did. But even with a couple of months of the year left, they felt they had to go back and look again. So they've revised their predictions again, which I suppose begs the question, what's the point of doing predictions if you change them every few months? But if you seem to get away with it like Savills do, then why not?
Yeah, I'm going to make fun of Savills a little bit, but I think that's okay because we put our necks on the line with predictions as well. So it's not like I'm just taking a pop at them. So nobody saw COVID coming. So I think it's fair enough to revise your predictions in the light of that. So at the start of the year, most people were saying, well, property prices might go up a couple of %. Then COVID happened. Everyone revised their predictions. Totally cool. So in March, Savills changed their prediction to say the property prices would fall by 10% in 2020. Then in June, they revised that to say, oh, actually, it will still fall, but the market will only fall by 7.5% in 2020. Then in September, they revised it again to say that house prices would actually grow by 4% in 2020. So between March and September, they've changed their prediction for what will happen in the next, at that point, 10 months by 14%. That's quite a big swing.
It is, but they're not the only ones at it because Lloyds have revised their predictions as well. But to be fair to Lloyds, they haven't done it as frequently as Savills. But they had previously said that property prices were expected to fall 6% this year, and they've now revised it to being up 2%. So an 8% swing in a few months. They'd also predicted commercial property prices down by 20% this year. They've halved that to 10%. And they've changed their numbers around what they're going to predict next year. I could read them out, but based on what we've just heard, I don't think it's worth it because they're probably going to change it again in a few months. But rather than just mocking these massive institutions for seemingly changing their minds every 5 minutes around where property prices are going, I think the important takeaway, the important lesson here, Rob, is that you shouldn't be making plans on headlines. We've talked about this so often, but the headlines now will say property prices are going up. But if Savills a few months ago said they were going down, along with Lloyds. So if you made investment decisions based on what they were advising only a few months ago, you'd be quite disappointed now to see that they changed their mind. I know it sounds quite dramatic to go, well, I'm not going to read a headline and suddenly alter my position on how I invest. But actually, people do. People would have read those headlines, would have looked at those predictions and gone, you know what, I'm going to hold off. It's not a great time now. Whereas actually property prices have started to move. Stamp duty holidays come in. Prices have gone on a mini surge. We'll see if it can continue. But the point is, if you hesitated, if you were previously going to go forward and then you decided to pause because you're reading all these negative headlines, that's really damaged you. But also, you shouldn't become too optimistic if you're seeing numbers on the up all the time. Because as we've seen, the people who are making these predictions are really just saying more of the same. They look at what's happening today and just marginally move it up or down. They never stick the necks on the line and, right, we're in for a huge surge before a surge happens, or we're in for a big crash before a crash happens. They just don't do that. So you should not use them as a guide for your investments.
So another busy month in the property market. They all seem to be at the moment, which is why these market updates are so useful. So to put you on the spot, Rob, how would you summarise all this? Taken all together, what does this mean for property investors?
Absolutely nothing. And I know that sounds mad because you're right, it is a busy month. It is absolutely crazy at the moment, the world. It has been for a long time now. But ultimately, what's changed from a month ago as far as property is concerned? Difficult market to operate in, but with opportunity. For every negative news story, you've got a story of stimulus from the government. And it seems that they're determined for at least the time being to push things on. So no matter how negative things get or how bullish things get, you shouldn't be really changing course month by month anyway. It's super useful as property investors to know what's happening in the world. And that's why we do these shows. But they shouldn't be dictating your strategy. Your long-term strategy is, by definition, long-term. You shouldn't be changing month by month on how you feel and how you should invest. So utilize this information, become a more informed investor, but don't be emotionally led by it. So I think that's the biggest takeaway for me this month is there's a lot of emotion out there at the moment and some of it understandable, but don't let it knock you off course as a property investor. Stick to the big picture, stick to your plan. While everyone else is getting excited, you stay steady and you'll do fine.
So there you go. That was your market update. Hopefully feeling a lot more informed than you were about 25 minutes ago. And we're going to keep on doing these monthly market updates until we get to a point where the world slows down and we're scrambling around for something to say. But there seems very little prospect of that happening anytime soon. So another market update next month, but another property podcast, of course, next week. And not just any episode. Next week is Property Podcast episode 400. And we've got something special planned for that. You won't want to miss it. And before then, on Tuesday, naturally, we'll be here with Ask Rob and Rob. So until then, as much as you can, enjoy your week. Bye-bye.